What you think might be an easy question, how do I write off a car, as you'll see, probably isn't as easy as you think. A lot of things in my job, I get questions all the time. People call up, Frank, I've got this real easy question. I know you're busy, but I'm sure there's an easy answer. And they call up, they ask the question, and they're right. The answer is easy. The answer is it depends, because as you'll see, it just depends on the facts of the situation. But basically, any customer that comes in here that buys a car, if they're using it for business, they're able to take advantage of these rules. That's the key. They have to be using the car for business. Assuming they buy a car, they have to make it. They buy the car, they get ready to prepare their taxes. They have one of two ways that they can expense the business use of that car. The first, probably the most common and the easiest, is what we call the mileage method. Basically, and you know, this is kind of a cheat sheet for everybody, and hopefully it may help you. If it's confusing, I apologize. I tried to make it as simple and as easy to follow as possible. But under the mileage method, the person adds up their business miles that they drove during the year and multiplies it for 2012. It'll be 55.5 cents a mile. That number typically is indexed. It fluctuates, depends on the price of gas, but already the government's announced that for 2013 that rate's going to be 56.5 cents a mile. So if someone buys a car, they've driven it 10,000 miles for business in 2012, they're going to get a $5,550 deduction on the car. Now, that's the one way, the mileage method. The one that probably will be more beneficial for people coming in here wanting to buy a car for tax reasons is going to be the actual method. As the name implies, actual means you add up all your actual expenses. That's gas, maintenance, repairs, taxes, insurance, and depreciation, and multiply it by the percentage of time that you're using the car for business. And you see I've kind of emboldened the word depreciation, because that's going to determine whether the person uses the actual method. That's usually the one number that tips it over the scale. And here's where these rules get really confusing, trying to figure out what is the depreciation on the car. Typically for your automobiles, the government says you can depreciate or expense that car over 5 years. And only in Washington is 5 years really not 5 years. But because what the government did is said, well, when you're using an automobile for business, we're going to limit the amount of depreciation per year. Year one is $3,160. Year two, it's $5,100. Year three, it's $3,050, and it's $1,875 after that. And that continues on out till you depreciate the car. So 5 years could really turn into 10, 15, or whatever, depending on the price of the car. They also said if you bought a light truck or van, and that's one, and I'm sure you've had customers ask about this term, that's one with a gross vehicle weight of less than $6,000. They give you a little extra depreciation per year. Year one is $3,360 instead of $3,160. Year two, it's $5,300 instead of $5,100. And in year three, it's $3,150 instead of $3,050. Now the vehicles that really get the most bang for the buck are the ones that have this gross vehicle weight of greater than 6,000 pounds. And I guess somebody tell me, what gross vehicle weight is the weight that the car carries? Is that typically what it means? Okay, well,
gross vehicle weight is the weight of the vehicle, the passengers, and everything.
Okay, that's what they're getting at. And so what happens? The government says if you're using a vehicle that has a gross vehicle weight greater than 6,000 pounds, then you truly can write that car off over 5 years. There's no depreciation limit. And that's usually in these situations, that's where the actual expense almost always is better than the mileage method, and that's usually what convinces the person to buy that car for, to save taxes. Now, in addition to just regular depreciation, there's some special other depreciation you can get that kind of speeds up how fast you can write the car off and how quickly, which gives you much better tax savings. The first is what I call bonus depreciation. And for 2012, basically, if you're driving an automobile and you buy this, first of all, the bonus depreciation only applies to new cars. And this is the last year this is going to be in place unless Congress does something between now and the end of the year to put it in 2013. But basically, if you buy a new car and it's an automobile, they're gonna give you an extra $8,000 depreciation that first year. So if you buy a $20,000 car, you're gonna get $8,000 off the top. And then you're limited to the other depreciation limits that I've listed up here, the 3160. If it's a light truck or van, again, they give you an extra $8,000. But on these big vehicles with the gross vehicle weight greater than 6,000 pounds, you basically, if it's a new vehicle, they can write off half the cost of that vehicle, 50%. If it's a $100,000 car, you get a $50,000 write-off that first year. In addition to that write-off, whatever's left that you haven't expensed, then you can do it over the remaining 5 years. So the numbers can add up. In addition to this bonus depreciation, is this what I call Section 179 depreciation, and that's Section 179 is the IRS code that this falls under. And this is the number everybody hears about, this $25,000 write-off. And what this section does, it says, in addition to regular depreciation, bonus depreciation, you can take another $25,000 in the year you buy the car or truck or vehicle. And really the 25 only applies to these vehicles that are greater than 6,000 pounds. So you can use you can use any one of these three or all three of them if you buy the right vehicle. So if you had a car that cost $100,000, you can take the 50% bonus, or $50,000, the first year. In addition, you can take this Section 179, which is another 25. That's a total of, what, $75,000. That leaves $25,000 of cost, and then you can depreciate that remaining cost over 5 years. So you can get a tremendous write-off in the first year if the vehicle has this gross weight of greater than 6,000 pounds. One question people ask about, do they get the same benefits if they buy or lease a car? And I don't know if y'all lease a lot of cars or not, but basically when you lease a car, you have the same thing. You can either use the mileage method or actual expenses, but under the actual expenses, instead of you don't get depreciation, you get to write off the lease payment. But what the government's done, because that almost always gives a good deduction, what the government's done is put in what I call this income inclusion amount, where if the fair market value of the car is over $13,700, the taxpayer has to go to these tables and see what this inclusion amount is, and what that number is intended to do is get the write-off more in line with what a depreciation deduction would do. So almost always there's no real benefit between leasing or buying a car in terms of the tax deduction, because this inclusion amount is intended to kind of equalize everything. Now, question we get a lot is, how do you go about determining whether, electing the mileage or actual method? And that you make that decision the first year you buy the car or truck or vehicle, whatever it is. And you have until you file your tax return. You can actually run 2 calculations and see which is best, and you use that one. If you use mileage method at some future point, if actual ends up being better, you can always switch to actual. But once you decide to use actual, they don't let you go back to mileage. Another question we get a lot, well, what's the deduction worth to me? I just use that example where somebody, the $100,000 vehicle where you got a $50,000 bonus depreciation, another $25,000, Section 179, and then you can then depreciate what's left over 5 years. The deduction is not the tax savings. People get confused on that. The deduction just reduces your income, and depending on what tax bracket you fall in, that decides what your tax savings is. So if someone bought a car and they just took this Section 1, the maximum $25,000 Section 179 deduction, and they happen to be in a 25% tax bracket, the tax savings is not $25,000, it's 25% of $25,000, or $6,250. Anytime you write off a car, the IRS says you should keep good business records. What is good business records? They don't really tell you how to do that. They just say you need to be able to substantiate the fact that you drove the car a certain number of business miles, and that can be in the form of a log or calendar that you're keeping, but you just wanna be able to say where you were on a particular day, why you went there for business, and the number of miles traveled. And obviously, if you're doing actual expenses, you're gonna need to keep records of your gas, maintenance, repairs, anything else, anything like that you've included in the expense. And lastly, I always have to put a disclaimer in here, that results can differ for different taxpayers. If you've got just an employee who say is a salesman using their car for business, their tax savings may not be as much as somebody that's a sole proprietor or an independent contractor or a partner in a partnership, or someone who's a shareholder in an S corporation or a C corporation. It's just a function of where the deduction ends up on a tax return. And certain deductions get limited and other deductions don't. Some deductions save you not only income tax but payroll taxes. So, I would tell you if someone, I don't know how y'all. I would suspect you don't try to give someone tax advice, but if nothing else, you might let someone, if they're coming in here to buy a car, and that there are tax deductions available to them through depreciate part of the car, take bonus depreciation, take Section 179, and if they want to know what that means to them, they can call their tax advisor or call me. I'll be happy to answer that for them.
Appreciate it.